నమస్కారం. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం విద్యార్థులకు స్వాగతం. ఈ ప్రసారంలో
Hello students, today we are discussing about the equity investment analysis. In this connection, first of all we have to assess the what type of investment system prevail in that particular economy. This investment system consisting of three components. One is financial institutions, financial markets and financial instruments. Financial markets are consisting of different types of stock exchange operations. Financial instruments consisting of equity shares, preference shares, debentures, bonds and mutual funds and other type of investments. Then financial system, generally we have the two types. One is the direct financial system and indirect financial system. Under the direct financial system, the money required persons are directly approaching the potential investors to accepting their investments. In this connection, the companies may issue equity shares, preference shares and debentures. For that purpose, today's our topic is equity investment analysis. A rational investor, how to take the decision about the equity investment. The equity investment analysis, basic objective of the equity investment is to appraise the intrinsic value of the security. The intrinsic value is the true economic worth of a financial asset. The fundamental analysis states that at any point of time, every share has an intrinsic value which should in principle be equal to the present value of future stream of income from that share discounted at an appropriate risk related aspect. So in this connection, one principle is there, P0 is equal D1 by KE minus G. Here P0 is equal to intrinsic value at the time period 0, D1 is equal to the expected dividend in the time period 1, KE is equal to capitalization rate, G is equal to growth rate in dividends. So after formulating the investment policy, the investor or the securities are analyzed through different ways, of which fundamental analysis is the most important technique. The fundamental analyst thought that the investments should appraise through intrinsic value. So for that purpose, the fundamental school of thought, the analysis divided into three categories. One is economic analysis, industry analysis, company analysis. The first aspect is the economic analysis. The level of economic activity has an impact of investment in many ways. The analysis of macroeconomic environment is essential to understand the behavior of the stock prices. The commonly analyzed macroeconomic factors are as follows. One is gross domestic product, national income, then per capita income, population growth rate, employment potentiality, savings and investments patterns, that is capital formation in the economy, then stabilization, interest rates, bank facilities, tax structure and the other factors like different types of mergers and acquisitions of the company, then delays in his business cycles. The business cycles are divided into three categories, particularly two aspects are taken into consideration. One is depression condition, another boom condition. Which state of affairs the economy, that we have taken into consideration. Then after that we go for the specific aspect, industry analysis. An industry is a group of firms that have a similar technological structure of production and produce similar products. The following factors may influence the stock market operations. One is size and structure of industry. That means again the size and structure we can divide into three types: large scale industries, medium scale industries and small scale industries. Generally the small scale industries, industrial entrepreneurs not depends upon the investors, directly they can approach the banks and financial institutions to mobilize the funds. Particularly large and medium industries have to issue the prospectus to the public in order to mobilize the funds through issue of equity and preference shares. The second aspect is the growth and profitability of that particular industry. So if the industry growth is good, there may be heavy potentiality for investment activity. If the industry also more profitable industry, then we may have the good opportunity to invest in that particular industry. Then another aspect is the competition and stability. Again the competition we can divide into different categories, maybe tough competition or the no competition, that is monopoly and monopolist competition. If the industry is enjoying monopoly and monopolist competition, there is a bright future about the investment activity. Further, the industry may be stabilized or not, that we have taken consideration. Again, the government policy, whether the government is favorable towards the industrial activities or not. So, because our Indian government, we can consider this a welfare state, mixed government. Time to time there are different types of rules and regulations promulgated by our parliament. For example, Indian Companies Act 1956, Foreign Management Act, then other similar acts may influence their investment pattern. In this connection, the functioning of SEBI also were taken into consideration, which indicates the government policy towards the industry investment pattern. Another one, labor positions. So that industry is suffering from any labor strikes and labor turnover, labor absenteeism, I like that. If the industry is a peaceful industry, no industrial unrest, there is a good investment opportunities. Similarly, whatever research and development facilities taken up by the industry, that also positive aspect. Particularly in case of whenever investor are willing to invest in pharmaceutical company, he has to concentrate on the research and development facilities. Then another one, industry life cycle, whether which line it is a maturity stage or decline stage or prosperity stage, which stage in industry, on that basis we can take the decision about the industrial investment. After choosing the industry, then you go for the company analysis. In the company analysis, the investor assimilates the several bits of information relating to the company and evaluates the present and future values of the stock. In this connection, two important factors, that is risk and related aspects. Risk and return we are taken into consideration. So that means the risk and return associated with the purchase of the stock is analyzed to take a better investment decision. The following are the important parameters for the company analysis. Then one is marketing activities. So whenever you want to assess the company's profitability, company's potentiality, the strength and weakness of the company, generally we are taken into consideration the marketing activities of the company. For that purpose, the sub aspects are sales, growth in sales, stability of sales. These factors were taken into consideration. If the company able to generate more and more sales, that company is more profitable, because profit is supported by the sales one. So for the investor has to take into consideration the pattern of sales over a period of last 10 years or 15 years. Then second one, the accounting policies, whether the business unit is following the standardized accounting policies or not. So whatever policies prescribed by the Financial Accounting Standard Board or International Accounting Standards Committee, that the unit is following or not. For that purpose, we have to concentrate more on inventory pricing, depreciation methods and non-operating incomes, because these type of information we can get through financial statements. Generally, the financial statements are consisting of balance sheet and income statements. These two statements indicates the strength and weakness of the company. For that purpose, we have to keep in mind what type of inventory policy they are taking, what type of depreciation method they are following, is the company is getting any non-operating expenses and non-operating profits. Then third aspect is the capital structure. Generally, the capital structure consisting of equity capital, preference capital, debenture capital or debt capital. In the entire capital structure, debt proportion is more. That company we can consider the risk company. That means we can consider the levered company. If you go for that capital structure is based on totally equity one, it is a non-levered company, then we can invest in that company without any risk. For that purpose, what are the composition of the equity shares, preference shares, debentures, that generally we go for the optimal capital structure of the business concern. The next aspect is the profitability of the business concern. What is the gross profit? What is the net profit? What is the return on investment? What is the EPS? What is the dividend per share, DPS? And what is the price earning ratio? Generally, the market price of an equity share in the stock market operations, generally we are taken into consideration EPS into PE ratio. On that basis, we can decide the what type of price prevail in that particular stock exchange. These aspects were keep in mind. Then another one, the management composition. So whether the management is a good management or not, what type of corporate governance is following, what is the ability of the management, what is the leadership quality of the management, whether that management is competence management or not, what type of judgments they are taking, what is whether the company is adaptability in a changing environment. So the development of science and technology they are taken into consideration or not. Then another one, social responsibility also we keep in mind. These factors we have to assess whenever you go for the company analysis. Then not only these factors, sometimes we are taken into consideration non-financial factors like history of the company, top management team, collaborations and agreements, mergers and acquisitions, and market standing and market share, industrial relations, corporate image, then stability and controls, business cycle stages, environmental aspects, and consumerism. Particularly we have taken into consideration the strength and weakness of the company management. That means that company management is expertise management in dealing with the business transaction or not, that management is a professional management or not, that we keep in mind. Then after analyzing the fundamental analysis, generally you go for the what are the features of the equity shares, because the investment we can go for through equity shares, preference shares, and debentures, of which equity shareholders are the actual owners of the company. Generally every investor has to become investor in the equity form of the investment. In this connection, equity shares are characterized by different factors like ownership and management, entitlement of residual cash flows, limited liability, infinite life, and substantially different risk profile, because whenever we are comparing the preference shares, the equity shares are more risky than the preference one. Whenever we want to value the equity shares, generally we are keep in mind these aspects. One is equity shares may have infinite life, uncertain returns, substantially different risk profile, makes valuation of equities a very difficult task. So further we go for the stock market operations. So listing of securities, trading on exchanges provide an exit rule for the investors, because one investor may transfer the shares to the other investor, that is investor gets replaced by another one. It is not possible in case of the preference shares. The value of the such replacement takes place is the key issue in the share valuation. Further, while valuing the share, it is a financial instrument characterized by the indefinite life, with the owner of the measure instrument bearing total responsibility for managing the business and entitled to only residual, that is the unknown, because after payment of dividend to the preference shareholders, then only equity shareholders may get. Sometimes they may get, may not get. So that is why the results are unknown. So in the valuation of equity shares, one does not know the discount rate of return, because which is the most important aspect. The cost of equity is the most difficult to find, since equity shareholders are the owners of the residual profits. That residual profits means after payment of interest to the debenture holders and the fixed dividend to the preference shareholders, after that only the equity shareholders may get the returns. In this connection, there is no legal commitment made to pay equity shareholders. As per the Indian Companies Act 1956, there is no compulsion about the payment of the declaration of the dividend to the equity shareholders. Then equity capital is normally classified into two ways. One is the profits that are not distributed but used for in funding the growth, called as the retained earnings. So whatever profit earned by the company, we cannot distribute to equity shareholders, because that funds we can retain in the business and that you can use it for the development of the business concern. It is called as the internal equity. Then another one, equity capital raised fresh to find the project's growth, called as the external equity. So whenever we require the funds from outside source, further we can issue the shares. These shares we can consider the presently we are offered to the equity shareholders. Then cost of equity is the most difficult one to ascertain, to absence any legal obligation to pay any explicitly stated cost. However, we cannot say that it does not mean that the cost of equity is zero. So in this connection, there are different types of approaches for the determining the value of the share. One is estimating the cost of equity based on the dividend derived model, that is called the DDM model. The cost of equity may be derived from the dividend growth model as follows. The principle is P0 is equal D1 by RE minus G. Again RE we can calculate return on equity, D1 by P0 plus G. G is the growth rate of the dividends. Then second, estimating the cost of equity earnings approach. Sometimes the dividend model may not gives the fruitful results to the investors. Then we go for the earnings approach. Earnings approach based on the cost of equity. Some managers tend to replace the dividend yield and the growth with earnings yield to the arrive the cost of equity capital. In this connection, the cost of equity is equal cash earnings yield, that is cash EPS for the next period into current market price. So, this way we can get the value of the equity share. Then after that, estimating the cost of equity based on the earnings approach. The earnings of the firm are either distributed as a dividends or retained in the business. So, one is a dividend policy or dividend payment to the equity shareholders, another one how much amount we are retained in the business. If the amount of retained is a constant of the earnings, that is B, hence the payout ratio 1 minus B, then the amount of dividend in period 1 would be E1 into 1 minus B. Further, the retained earnings provide return of K, growth earnings would be B into K. B indicates the retained earnings, K indicates the cost of equity. Putting these values, we can get the one equation that is called as the P0 is equal to D1 by RE minus G. Again, E1 into 1 minus B by RE minus B into K. When R is equal to RE is equal to K, that means return on equity is equal to cost of equity. Then P0 is equal to E1 by RE minus G, or otherwise RE is equal to E1 by P0. Then estimating cost of equity, another model, that means a DDM model and earnings model have these certain setbacks when we are considering the firm's concrete growth and do not pay dividends at all, only irregularly. Growth rates may also be hard to estimate. In this connection, we go for this investment pattern with a market risk. For that purpose, the model is called the CAPM model, capital asset pricing model. So, therefore, many financial managers prefer the security market line and the capital market pricing model, that means security market line SML or CAPM model for estimating the cost of equity. In this connection, there is a one equation RE is equal to RF plus beta B into or beta into RM minus RF. RE indicates the return on equity, RF means risk free rate of return, B is equal to beta, beta indicates the systematic risk of the investment system, because the investment activity risk we can measure, we can classify into two categories. One is systematic risk, another one unsystematic risk. The systematic risk measured with help of the beta coefficient. So, beta into return on market minus risk free return, or other way we can present return on equity is equal to risk free rate plus risk factor into risk premium. So, there are certain advantages in deciding the cost of equity through CAPM model, because cost of external equity also we can calculate. That means cost of external equity is the more than the cost of retained earnings, due to this cost of external equity consisting of flotation cost, underutilization of the capital raised and underpricing newly issued shares. For that purpose, the cost of return equity is equal to 1 by 1 minus F into D1 by P0 plus G. Here P0 is equal to dividend paid at the time period 0, that D1 is equal to P0 is equal to price of the share price at base year, G is equal to growth rate. Then cost of new equity is equal to D1 by RE minus F plus G. F indicates the flotation cost. While issuing the shares, sometimes we can incur certain expenses like the legal charges and brokerage or commission. So, whenever we want to understand the investment pattern or risk pattern, generally we have to take into consideration certain models. On that basis only we are keep in mind one case presentation here we have presented. That means from the following data we can estimate the value of equity shares by using the different methods like dividend derived model, then earnings model, CAPM model. So, generally as a student of specialized in finance way, whether we are purchasing the shares or not, for that purpose we have taken into consideration one case study model, that is current market price of the share is 42.09, dividend in the year is 0.48, dividend growth rate is 5.5% per annum, Then estimated earnings EPS is equal 2.232 and equity risk premium, that is called as the 5.9% and risk free rate is 5.74%. Beta of the company is equal to 0.69. So based on this information, we can calculate weighted average cost of capital by taking into consideration all the capital structure, that is called the 9.27%. Then the terminal growth rate is 3%. Free cash flows we can estimate it with the help of the data. So that is called as the certain 5 years figures we are taken into consideration. On that basis, we are keep in mind whether we have to invest in the companies or not. For that, based on the computerized calculation to discount the cash flows in the Excel sheet, we have calculated the weighted average cost of capital is 9.27% and the present value of equity is 58.13% and which is the more than the current market price, that is 42.09%. In this connection, a rational investor has to take the decision it is better to invest in this company. So this way we can analyze the equity investment pattern. So every investor has to take into consideration, so how to invest, when to invest, where to invest the company. For that purpose, you go for the generally fundamental analysis. So whenever our market price is different from our calculated price is called as the theoretical value of the price. That theoretical value we can decide with based on the above presentation. These values we can compare with the market value. So on that basis we can decide the value of the share. For that purpose, generally we are keep in mind two aspects. One is risk associated with the investment pattern and what amount of return we are going to receive. So if the return and risk are equal, we should not invest. Our return is more than the risk, which may be either systematic risk or unsystematic risk. Generally we go for the investment pattern. So in this line we can assess the equity investment analysis. Whenever we are comparing with the other type of investment, equity investment analysis is a very difficult task. So we should keep in mind various factors we can keep taken into consideration. On that basis only we can go for. For that purpose there are two popular models. One is CAPM model, another one arbitrage pricing theory. These two models indicates that a rational investor has to take the decision about the investment pattern or not. So on that basis only we can think of whether your investment is safe or not, which company shares, which industry shares, which economy shares, whether you go for the purchasing of securities or not, that we have to decide. So this way we can analyze the investment pattern or investment system by a rational investor. Then only your investment may be safe. You may be long term investor but not the speculator, because we are keep in mind whether investment system is investment or speculation or gambling activity. Generally if you go for the long term investment, generally we have to avoid the speculation and then gambling activities. Only we have to concentrate investment. For that purpose, this investment analysis helpful to the investors in many ways. So this is the brief note about the investment system. If the students are having any doubts, you can clarify, and then we can assess your presentation.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు ఆహ్వానిస్తున్నాం. మీ సూచనలు సలహాలు మాకు తెలియజేయవలసిన చిరునామా: డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500033.
Good morning to the viewers of this particular lesson, and today we are going to discuss about the financial statements analysis of interpretation of the financial statements. Financial statements are basically known as the end results of the business activity, and main objective of understanding these financial statements are what are the financial statements and how far these financial statements are useful for the purpose of facilitating decision making by the management as well as other parties interested in the business. First, let us know about what is the financial statements. As we all know that accounting is basically the process of recording, analyzing, classifying, summarizing the various business transactions, and these financial statements are called as end products of the business transaction. That is, the result of all the business transactions. For the purpose of definition point of view, financial statement is a collection of the data which is organized and accordingly logical, consistent accounting procedures. These financial statements are basically prepared for the purpose of understanding various financial aspects like assets, liabilities, profits of the business organization for a particular accounting period. That means these financial statements are prepared at the end of every financial period. Normally, at the end of 1 year period, we use it to prepare these financial statements. These are also known as the financial reports. That is, reports are meant for the purpose of giving the end result of the various business transactions. The term financial statements generally refer to the two statements. One is balance sheet and other is the profit and loss account. But according to the generally accepted accounting principles, the financial statements are given as a full set of financial statements, that is balance sheet, income statement, statement of changes in the owner's equity position, and statement of changes of the financial condition of the firm, that is funds flow statement, cash flow statements. Let us understand about them in detail. A balance sheet is a statement of affairs of the business concern at the end of a particular period. Balance sheet basically shows about the assets, liabilities of the business concern on a particular end date. The end date normally prepared at the end of the financial year, that is 31st March of every year. The balance sheets are prepared by the business concern, and the profit and loss account is also prepared as a part of the financial statements. It is prepared to determine the operational efficiency of the business concern, that is income, expenditure and various other aspects relating to the operational aspects of the business concern. Balance sheet shows a particular date what is the asset and liability position, whereas the income statements prepare what is the result of the operational activity, that is either the profit or the loss that is generated by the business enterprise. These statements are very essential to take any sort of the financial decisions. Coming to the next, that is owner's equity. It refers to the changes in the ownership funds of the owners. Statement of changes in the financial position, it is explained by the funds flow statement and cash flow statement. Coming to the funds flow statement, it is prepared to analyze the changes in the fund position of the business concern. The fund position between the two accounting periods. Funds flow statement is actually a comparative statement, that is how the fund moves from one particular accounting period to the next accounting period. This fund basically denotes what is the changes in the working capital. This is the difference between the working capital is the difference between current assets and the current liabilities of the business concern. Funds flow statement is prepared on the basis of changes in the working capital of the business enterprise. In the case of the cash flow statement, we prepare what is the changes in the financial position of the concern at the end of the year on the cash basis. Instead of using the working capital base, we use how the cash is coming in and how the cash is going out. So, we can conclude that if you prepare the statement of changes on the basis of the working capital, we call it as the funds flow statement, and if we prepare on the basis of the cash, we call it as a cash flow statement. But usually to discuss about the analysis of the financial statements, we use only the balance sheet and income statement. What is the objectives? Now coming to the objectives of financial statements. Why to prepare these financial statements? The basic objective is to help the owners, management and other people to know about the financial aspects of the business concern. The other objectives is to provide the reliable information about the firm and the resources, what are the obligations of the firm and changes in the economic resources of the business organization and so on. Estimating the earning potentiality of the business is also identified by using these financial statements. And what is a best financial statement? A financial statement should provide the correct and the true fair view of the business enterprise, and it must be easy to understand and it must be reliable and it must be relevant to the objectives of the business enterprise. And the financial statements prepared at the end of the period should be promptly responded to the management, otherwise the basic objective of the financial statement is lost. And now we have learned about lot in the case of the financial statements. Now how to analyze these financial statements? That is the next aspect. Financial statement analysis is the process of determining the strengths, weaknesses of the firm relating to the business and also establishes the relationship between the items of the balance sheet and also the profit and loss account. That means we analyze these financial statements for the purpose of giving a reasonable understanding to the people who study about the financial position of the concern. The main objective of financial statement analysis is to provide the information contained in the financial statements and to judge the profitability and the position of the firm. This financial statement analysis includes both analysis and interpretation of the part also. Analysis is basically talked about simplifying the data for the purpose of understanding, easy understanding say, and interpretation is giving the conclusive evidence or conclusions about the financial statements. And whereas this both financial statement analysis and interpretations are interlinked with each other. Without analysis we cannot interpret, and without interpretation whatever the analysis we make is also meaningless. And if we use this interpretation of the financial statements and also this interpretation in a logical way gives conclusive understanding about the whole financial position of the firm. Now coming to the point of what are the different classifications of this analysis. One is horizontal analysis, second is vertical analysis. Horizontal analysis, vertical analysis are the two parts of the analysis. Horizontal analysis refers to the comparison of financial data over the previous years, that is previous year's data is compared to the current year data, and we can do the horizontal analysis over the number of years also. Each year data is analyzed over a period of time on a columnar basis. This is also called as horizontal statements. Coming to the vertical analysis, how to refer this study from the point of view of the relationship between various aspects of the financial statements. That is, we analyze the particular current year data only, whereas we understand the relationship between the aspects of the current year financial position or a year of a particular position. Coming to the next, in the case of the vertical analysis, we analyze the gross profit ratio and all so on. Just let us take an example. Gross profit is analyzed as a part of the sales. This point is also comes under the vertical analysis. Now coming to the various tools of analyzing these financial statements. There are different tools. Along with that, the most important tools for the purpose of analyzing these financial statements are comparative statements, common size statements, trend analysis, ratio analysis. Coming to the comparative analysis, comparative statements is the data pertaining to the more number of years, and it is analyzed by preparing a comparative analysis form and it is used for both balance sheet as well as the income statement. In this case of the comparative statements, we take the 2 years or more number of years of the data also. This comparative statement is used for balance sheet and also for the profit and loss account. In the case of the comparative analysis, we prepare absolute figures for 2 accounting periods and what is the changes between the values of the 2 years, and that is called as absolute value, and increase or decrease of percentage, increase and decrease in terms of the percentage is identified. On the basis of the relative figures, that is percentage of increase, percentage of decrease, the analyst can draw the conclusions out of the, and he can draw the interpretations. Coming to the next tool, that is common size statements. In the case of common size statements, each item is explained or each item is analyzed as a percentage of one base value. That one base value is said to be the net sales in the case of the profit and loss account, and in the case of the balance sheet we talk about the total of assets or total of liabilities. So, in the case of the common size statements, each item is expressed as a percentage of the total of the value. Let us example, in the case of the income statement, we express each item as a percentage of the net sales, say gross profit as a percentage of net sales, expenses as a percentage of net sales, and so on. In the case of balance sheets, we can analyze that each item of assets as a percentage of total assets. Coming to the liabilities, equity capital as a percentage of the total liability, and so on. Thus, each item is expressed as a percentage of the total item. That is why the percentages are more essential in the case of the common size statements. Coming to the trend analysis, under this particular situation, each item is expressed as a percentage of item of the base year. For example, in the case of trend analysis, we use the 1 year value as the basis and all other years of the values are expressed as a percentage of the base year. Say, let us assume that the sales of the first year is analyzed as a percentage of last 3 years. Say, let us assume that there is a data for the 4 years. First year data is taken as the basis and second year data, third year data, fourth year data is expressed as a percentage of the first year data. That means it involves the calculation of index numbers of the various financial values. It helps to understand the movement of various values or the financial items over the number of years. This is about the trend percentages. That means trend observes about movement of upward or downward and so on. That means if the values either they are moving upward or downward is compared, and the analyst can draw a conclusion out of this one. Next, coming to the part of the ratio analysis. The ratio analysis is mostly a very powerful tool for the purpose of analyzing the financial statements. Ratio, as we all know, it is the mathematical expression of the relationship between the two values. This one value is known as the numerator and other is known as the denominator. This simple aspect of ratios is also useful for the purpose of analyzing these financial statements. When we use both the financial values, we call it as the financial ratios. One financial value is expressed in terms of the another financial value numerically. It is known as the financial ratio. For example, we can use the gross profit ratio. That is, gross profit is expressed as a percentage of the total sales or net sales. That is called as a gross profit ratio. Here we want to analyze the relationship between the gross profit and the net sales. That means how much percentage of the net sales is coming to the end as a gross profit. That is, we are establishing the relationship between the gross profit and to the net sales. In the similar lines, you can establish the relationship between current assets and current liability, fixed assets to shareholders capital, and so on. These are called as ratios. These financial ratios are basically a powerful tool for giving the total understanding about the financial statement analysis. What is the procedure? Now coming to the procedure for calculating the ratios. The procedure basically involves the 4 steps, that is 1. Selection of the relevant data for the purpose of analysis depending on the analysis we require. Next, select the appropriate ratio for the purpose of giving a meaningful conclusion. This calculation of appropriate ratio also varies according to the opinion of the analyst. Compare the such ratios after calculating with the 2 aspects. One, with the ratios of the same firm within the previous years or with the industry standards. That is, let us example, the gross profit of the previous year can be compared with the current year gross profit or the previous year's gross profit. On the basis of this one, you can estimate what is the gross profit that the firm can get over the further period. Ratio analysis, we can use the industry standards also. Industry standards is the standards prepared within the particular industry. After calculating the ratios, we go for the interpretation of the ratios. This interpretation of ratios is comparing the ratios of the firm with either industry or with the previous ratios of the firm. Now, ratio analysis is highly useful to analyze the financial position of the firm for the different parties. Let us assume that creditors also calculate these ratios for the purpose of understanding the firm's ability to pay off their debts, whether the firm is able to pay or is there any risk in the payment of the amount back to that. In the same way, the investors also use this ratio analysis for the purpose of identifying what is the return they can get out of the investments made. These ratios are classified into the different ways. Actually, there are so many ways of classifying the ratios, that is statement position ratio, functional ratio and so on. Coming to the functional classification of the ratios, which is the most important classification, ratios are classified as liquidity ratios, turnover ratios, solvency ratios and so on. Let us understand about one by one in detail. Coming to the liquidity ratios, basically these liquidity ratios are useful for the purpose of understanding the firm's ability to pay off the debts over the shorter period of time, that is ability to pay the regular day-to-day expenditure, payment of salaries, wages, electricity and so on and so forth. This liquidity ratios basically tells us about the firm's ability or firm's capacity to meet the short-term obligations. There are different ratios which is used for the purpose of calculating the liquidity or current ratio, acid test ratio, absolute liquid ratio and so on. Current ratio is a ratio between current assets to current liabilities. Acid test ratio is the ratio between liquid assets to the current liabilities and so on. Like that, different 2 parameters are considered for the purpose of understanding these ratios. Next, long-term solvency ratios are also calculated. These long-term solvency ratios, basic objective is to understand the firm's ability to pay the debts in the longer period of time, that is either it is able to pay off the debentures, long-term loans and so on. That long-term solvency ratios basically talk about long-term ability to pay, whereas liquidity ratios talk about the short-term ability to pay. The different ratios in this case is debt equity ratio, proprietary ratio, fixed assets ratio, capital gearing ratio and so on. Coming to the other type, that is turnover ratios. These ratios basically tell us about how best the firm is able to perform or utilize the resources of the firm. Coming to these ratios, capital turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio. All these ratios take individual item and finally we will calculate the ratio. General profitability ratios is also taken off this one. This particular general profitability ratios talk about the operational efficiency of the firm. Under this category, we talk about gross profit ratio, net profit ratio, operating ratio and expenses ratios. These ratios tell us about efficiency of the firm in the short run. In the case of the overall profitability ratios, these profitability ratios tell us about the shareholders' point of view, how best their funds are used and how much return they can get. That is return on investment, return on capital employed and return on equity shareholders funds, earnings per share, dividends per share and so on. These are the various ratios which are used for the purpose of understanding the financial position. There are other types of ratios also, that is coverage ratios. These coverage ratios tell us about the firm's ability to pay the various fixed items, that is interest, dividends and so on. Along with that, other ratios are also used. These ratios is used for the purpose of estimating the predictive power of the firm. Like that, ratio analysis is a comparative tool and a comprehensive tool for the purpose of analyzing the financial statements. Out of all this, financial statement analysis is the most useful for the purpose of analyzing the balance sheet and profit and loss account. And these financial statement analysis gives a broader view for the various parties of the business, that is investors, shareholders, creditors and so on. So thus we conclude about the financial statement analysis in this particular topic. Before concluding the session, let us summarize about what we have learned today. So starting with the point of financial statements, we have studied about what are the financial statements, what is objectives of understanding, that is how best the financial statements are useful for the purpose of facilitating the decision making. As we have studied, the financial statements is a summarized reports after preparing the accounts, and these financial statements are useful for the purpose of investors. In simple, balance sheet and profit and loss account are concluded as the financial statements. These financial statements are analyzed for the purpose of taking the decisions for the present and also for the future. The different financial tools that we use for the purpose of analyzing these financial statements are the comparative statements, common size statements, trend analysis and also ratio analysis. Out of all this, ratio analysis is a largest tool, and comparative statements, common size statements, trend analysis, these three are calculated on the basis of absolute values. Coming to the last, that is ratio analysis is a elaborative tool which is used for the different investors, different parties, stakeholders of the business. Each individual ratio is having its own effect and own conclusions, and finally you can say that analyst has to select about which type of tool he has to use. Either he can go for the comparative analysis or finally he can use ratio analysis. Which tool is to be used depends upon the purpose of analysis, objective of analysis and what he wants to derive out of this conclusion. And at the same time, vertical analysis, horizontal analysis is also a part of this one. The analyst finally draws the conclusions and finally he will interpret the results.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు ఆహ్వానిస్తున్నాం. మీ సూచనలు సలహాలు మాకు తెలియజేయవలసిన చిరునామా: డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ B.R. అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ G. రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500033.